Hello, everyone. My name is Gary Quinzel. I'm the Vice President of Portfolio Consulting at Wealth Enhancement. Thanks for joining us today on this edition of 7 Market Movers. Ever since we started doing this weekly series back in March, things have certainly quieted down quite a bit. Ever since the Liberation Day on April 2nd, things really deteriorated from a market perspective. We know that volatility spiked and the major equity markets here in the U.S. dipped into bear market territory. We, of course, saw the S&P 500 drop around 21% from its February 19th peak. But in the days following that, we had some good news, and the market has done almost a full round trip. And we're not quite back to where we were back in February, but we've certainly made up most of that lost ground. So what has happened since then? I think most of us at this point know that there's been a 90-day pause between first the U.S. and many countries that were originally willing to negotiate, and then following that, the big news came when the U.S. announced a pause against or with China, I should say. And so that was the big news a few weeks ago. Since then, we really haven't had any major breaking news on the tariff front. Things seem to be kind of holding steady, which is good news. Anytime you have no news is good news. Certainly is uh, makes sense here. But the big story this week, I think, really was more about the bond market. And so there's been a lot of talk about national debt and net interest expense. And middle of the week, we had a Treasury auction which had much weaker than expected demand, and that was kind of a signal that maybe there's some rising concerns about our national debt and our net interest expense. And there's some concerning numbers out there. Some of those that we're familiar with, such as the fact that our current national debt is around $36 trillion. 2024 fiscal year, I think we paid around $881 billion in debt interest. Seems to be going on a very high upward trajectory. And of course, we had around a 1.83 trillion deficit last year. And so, what the problems with that is we're seeing a rise in yields, and we saw that this week. We saw the 10-year Treasury go up to around 4.6%. We saw the 30-year up above 5%, and those are some alarming numbers. There's been some studies about at what point does the rising bond yields really impact the risky markets such as stocks, and 5% certainly is one of those marquee numbers. There's another study from Goldman Sachs recently that said anytime you have a 2 standard deviation move within a month, that could set off some alarms. And for the 10-year yield, that would be around, if we got to 4.7 this month, we're not really that far off of there. So, the challenges in the bond market have kind of leaked into equities the last couple of days. Even though we've generally had a pretty strong month here in May, we did have a couple down days the last few days, and that kind of circled around that weaker than expected bond auction, as well as now that we had a narrow passing of the new tax act that just recently passed the House. The expectations are that's going to continue adding to the deficit and, of course, increase our interest expense. And so while there's some good to be taken out of that, there's also certainly some challenges on the bond front, and that is something that we're going to be paying very, very close attention to here at Wealth Enhancement. But in the short run, we're certainly fortunate that the tariff situation has de-escalated. Equities certainly like that. We've noticed that the S&P 500 is up around 4.4% month to date. International continues to actually do even better. The MSCI EAFE index, EAFE index, has done around 5.5% month to date, while the emerging markets index is up around 5.85%. So we're continuing to see stronger performance out of international stocks. Part of that is also due to the U.S. dollar, which continues to come off its multi-year highs and soften a little bit, and that's actually helping propel some of the international returns. On the bond side, I already talked about how yields have gone up. That means bond prices have gone down. So if you're investing in the U.S. Ag Index, that's down around 1.6% month to date. Still not terrible, still doing okay overall from a diversification standpoint, but we're seeing some weaker price movement on the bond side. The VIX, the volatility index that measures equity index, back down to pretty normal levels, closer to around 20, certainly a level that we'd like to see continue to come down. And the hope, the expectation is that, we can continue to see, promising news on the tariff front, and that the left tail situation, that's how we map out the probability of worst case scenario, continues to lessen. So For now, that's the news that we have, and we're fortunate that things continue to quiet down. So that's all for today. Hope you found today's update helpful and useful. And as always, if you have questions, please reach out to your financial advisor, and they can, of course, put you in touch with somebody from the investment management team if you have any further questions. With that, thank you all for listening and watching today. Hope you all have a great day and a great week. Take care.